Welcome to another episode of Market Wars. Today, we unravel one of India's biggest stock exchange battles, MCX-SX versus the giant, NSE. Traders welcomed the competition. With new opportunities in currency trading, MCX-SX quickly gained market traction. But NSE wasn't happy. To maintain dominance, they introduced a bold strategy, offering currency trading at zero transaction fees. In 2008, MCX Stock Exchange entered currency derivatives trading, aiming to challenge the dominance of the National Stock Exchange, or NSE. The move worked. Traders flocked to NSE's free services. MCX-SX struggled to keep up as business declined rapidly. MCX-SX's revenues plummeted. How could they compete when NSE was practically giving away services for free? Inside MCX-SX, tensions rose. They suspected NSE was cross-subsidizing, using profits from other businesses to cover its free services. Was this even legal? But before we go further, let's talk about why this case matters. India's Competition Act, 2002, was created to prevent unfair trade practices and ensure a level playing field for all businesses. MCX-SX decided to take action. They approached the Competition Commission of India, filing a complaint against NSE for predatory pricing. CCI then launched an investigation. They found that NSE wasn't just reducing prices, it was covering losses using profits from stock trading. This created an unfair advantage. Traders began questioning NSE's tactics. What happens when MCX-SX is gone? They wondered. Will NSE raise prices once it eliminates competition? This is a classic example of a market monopoly. When one player dominates the industry, competition dies, and prices eventually rise. Under pressure, NSE received a legal summons from CCI. The allegations were serious, and a formal hearing was set. In 2011, the hearing took place. NSE defended its strategy, claiming it benefited traders. MCX-SX argued that NSE's methods were harming fair competition. After reviewing the evidence, CCI ruled in favor of MCX-SX. NSE was found guilty of unfair trade practices and was fined 55.5 crore. The verdict sent a strong message. India's stock market needed fair competition, and regulators were ready to act against monopolistic practices. This ruling didn't just impact stock markets. It set an example for industries across India, ensuring that companies compete fairly instead of eliminating rivals through unfair means. After reviewing the evidence, CCI ruled in favor of MCX-SX. NSE was found guilty of unfair trade practices and was fined 55.5 crore. This case set a precedent in Indian business law. It reinforced that competition must be fair, ensuring a level playing field for all businesses and protecting consumer interests.